right, good afternoon, everybody. This is Peace of Mind Radio, and we do have Chris Vaughn with us, and Tad Douglas, and Amy Kniseley.
You got it.
See, I did pretty good.
You did
All right,
great.
anyway, yeah, so we have a guest, Amy. We sort of mentioned that in last week's show, that she was sort of camped out in the corner, sort of observing the last show. She thought we were going to, like, be mean, or, I don't know, it was going to be tough. I don't really, but I will say this. She has her laptop out. So, like, it's going to be some serious conversation today.
Oh, yeah.
I mean, it's, yeah, we're all, half the time my notes are not even right. So she's stepping up the game for us a lot.
She'll make us look bad because we fly by the seat of our pants.
That's right.
Right.
She's got figures in front of her.
I know.
No, but there's some really cool things that I want to make sure that we don't miss.
That's right.
And that's great.
Right.
Thank you.
Yeah. Well, it's kind of cool that you have your laptop there. Maybe I should start doing that.
I was just thinking, I feel guilty. I need to bring my laptop in so that I actually look like I know what I'm doing.
Yeah, but you know what? I'm afraid that, like, I would see, like, some stat run across the bottom of my screen. I would, kind of pay
Like a
attention
score or something like that,
Yeah.
like games.
Yeah,
Yeah.
Checking her email.
to. Yeah, or an email. Yeah, get an email from no, I'm not gonna say it. I was gonna say wholesaler, but that's I'm just kidding. That's an inside joke for everybody. Anyway, all right. So what we're talking about today is something I think we're all passionate about, and that I have sort of stepped into this role several years ago. Where, and I'm gonna get more into this later in the program, but talking about long-term care, right? It's something that we all know is out there, and I think most clients sort of know it's out there, but they really don't want to talk about it because it's sort of that end-of-life discussion, which nobody really likes. And there's certain things that you can do that you can put in place that would sort of help throughout that. And that's really what we're talking about. But I think, first of all, we're going to talk more statistics, just because I like talking about stuff like that, right? Amy's like, oh, God, statistics. But that's okay. We're going to be quick with that. Actually, when we were putting the show together, I kept saying, I want to talk about statistics, and everybody else was like, no, let's go do something else. And I was like, no, I want to talk about statistics. And everybody's like, no. But daggone it, we're talking about statistics because I've got the mic right now. So anyway. All right, so before we get started, if you hear anything on the show today, or if you have not put anything in place to sort of protect your assets as you advance in age, or you're worried about it, especially, I think Amy's probably going to have this conversation, is if you have, maybe not, she'll look at me like, oh my God, dude, here you are, you're saying something, I don't know what you're talking about. No, but if you have history of your parents have dementia, or you have a history of, cancer, you're going to want to make sure that you have this conversation, and you have things you can put in place now when you're healthy, right? We're going to talk about that, so that it can protect you when you get later in life, right? That's sort of the premise behind making sure that you're planning in advance. Long-term care is not something that you get sick and then you plan for it. Typically, it's better to plan more in advance and have things in place that can protect your assets when you get older.
Exactly. The minute you have a cognitive impairment or break a hip, cancer, any kind of health condition, it's too late, right? And your plan is only as strong as your weakest link.
Yep. And
Plain
so,
simple.
yeah, absolutely. And it's sort of a play off what we talked about last week when we had Kristen on the show, and she's camped out in the corner now. But we were talking about her Mount Everest story. And if you didn't hear that, make sure you go back to last week's show and couch the Mount Everest story, because it's a pretty cool analogy, which we're going to use sort of moving forward.
Yeah.
And I told her I was going to steal that. But it's making sure that you put a plan in place so that and Chris and Tad both, we've had multiple conversations around when you put a plan in place, a client can say, hey, what happens if I become
Whatever.
impairment,
Yeah.
whatever. You can plan for that, and you can say, okay, here's what happens when that happens, and here's what happens to your assets, and oh, by the way, if you put this in place, look at the difference between when you have nothing in place versus when you have things in place, right? And this gives you the information that I believe, and we all believe, because we're all shaking our heads, that it gives you the information that you need in order to make a sound financial decision. And that's what a proper financial plan does, right? So we're really focused today on the long-term care aspect of your life. So we're talking more advanced age, but not always, right? I mean, we had a client we dealt with years ago when I was at the bank that was 42, 43, and was in a car accident and needed basically care her entire life, right? And she was healthy otherwise, so it was, you never know when it's going to happen, right? But let's start off, let's talk statistics. And do any of you guys want to talk about that? I know none of the three of you all do, because you made it very apparent when we were prepping. You're
Correct.
Like, so, but we're going to talk about him anyway. So, Tad, very first bullet point there. What is the average per stay per day of? It's really long-term care. It's just an overall statistic. But what is the average per day price? Am I saying that right? Yeah. I think I am.
Well, I think it's easier to me to remember it on a monthly or an annual basis. It's around $80,000 to maybe $90,000, depending upon the level of care needed.
Yeah. Okay. Well, so you're smarter. You want it annually. I was trying to go by day.
Right.
But,
Or the area of the country you're in, right? Or do you want a semi-private or private home? Like how do you want to live those years? What kind of care do you want?
yeah, that's right. And I think I look at it more on a per day basis, because that's what a lot of the policies will say. You get X amount of, per day or whatever. So I think I see that. But yeah, if you're that's a staggering number. I was actually very fortunate. I mentioned this to you all, and Ted, you knew about this, but about 2 months ago, so back in July of 2019, I was actually asked to go and speak about long-term care planning to the Elder Care Law Society of Kentucky, I think is the actual term for it. But anyway, it was pretty interesting. They wanted an advisor's perspective on how we see things, because it was a room full of attorneys, right? Now, they were all there to get CE credit, so they probably weren't really listening to me, although there were a few of them were, because they would ask questions. But the interesting thing was, the concept of this was that they wanted to, they're obviously there to talk, the challenges that attorneys see in the long-term care space, and this is around Medicaid planning. But what they had me there for was to sort of give a perspective of how an advisor sees this, and how an advisor would work with clients when we're talking latter stage of life planning, or what I always refer to as elder care planning, and how we interact with the attorneys. And it was pretty interesting. And then I promise we'll get more to the statistics in a minute. But the number one question that they asked the moderator was, what is the number one challenge that you see on your side of the fence that is the biggest challenge when it comes to elder care planning? And essentially I said, it's the lack of communication between the attorneys and the advisors.
The advisor, yeah.
Right? But I think and I say that because I want to get more to that later in the show, but I think part of that is the lack of the conversation, which is another challenge in our world, that advisors don't fully understand long-term care. They don't understand the full impact of long-term care expenses on an estate, and so they have a tendency not to have that conversation, right? And that's really what the purpose of today is. Let's talk about long-term care. Let's talk about what the solutions are out there, right? And that's really the purpose of what we're trying to accomplish today. And really, the statistics, I just want to throw out there because I think the numbers are staggering. One of the statistics that we talked about at this conference, I asked everybody if they knew what the average expense was for a person that goes into Kentucky long-term care. What's the average, total expense that person experiences over their course of their care? And they threw out numbers all over the place, but it's around $300,000. Right, for the total care. And that's starting with maybe in-home care all the way to advanced like nursing home care, right? And I said, okay, so the average is $300,000 worth of expenses. Now, what's the average savings that a person in Kentucky has to position to pay for those expenses? And none of them even came close.
Yeah.
It's $109,000. That's staggering if you think about it. So that tells me that people are not planning appropriately, right? So that's why we're having the show, is to make sure, just to bring awareness that, if you haven't done the plan, make sure you're reaching out to us to say, hey, I really haven't done anything. Sort of walk me through what I need to be thinking about, what options are out there. Hey, I heard Amy talk about, and by the way, we never really properly introduced you. I'll do that in the start of the next segment. Sorry about that.
That's all right.
Somebody should have said something. These guys are not doing
You
their
were just
job.
going, man, so just
I know.
We're
let it go.
excited. Yeah.
All right, so we'll be right back. This is Peace of Mind Radio, and I promise you we will introduce Amy Kniseley.
You got it. Yes. You
Amy
got it.
Kniseley on the other side of the break. Come right back. This is Peace of Mind Radio, and it's interesting that Jim threw this on there because for some reason Ozzy has to have long-term care expenses coming up at some point, right?
There's definitely cognitive issues.
Oh my
Oh.
God,
There
that
have to
dude, he can't speak a sentence. I know words come out, but it's like jumbled all together, and he is
I don't
already.
think he knows
But
what
in
he's saying
Yeah.
anymore.
fairness, it's been like that a long time.
That's true. I did see a documentary on him. We're totally off subject, but they were talking about his, his shows, and they were like, "Hey, dude, how do you remember all the lyrics?" And he's like, "What's on the teleprompter?" So he's karaokeing at his concerts, which is pretty interesting.
That's funny.
Does he have the bouncing red dot? That's the part
I
I
know. I know. I'd bring up something else, but I'm not gonna do it on this radio show. But it's a funny scene of the movie about Motley Crue. You know probably what I'm talking about.
I know the movie. I haven't seen it. I know
Okay,
what
yeah.
you're talking
All
about.
right. Anyway, all right. I said this at the last break, and I apologize, Amy. I did not properly introduce you in the first segment, which I should have done. But why don't you? You're not from here either, correct?
No, I'm actually from the Midwest.
Okay.
Yeah, I'm
Where?
originally from Wisconsin.
Oh, really?
Yes,
Oh,
sir.
Cheesehead.
I am a
Oh,
huge Packer
cool.
fan.
Okay,
Yes.
yeah.
I like you a lot more now.
Yeah, high five.
Yeah,
All
well,
right.
your boys are having a pretty good year this
They're
year.
having a great year.
I know.
Some of the games were a little,
I know.
not the prettiest, but a
That's
W is
okay.
a W, so
That's
we'll
right.
take it.
So, once you explain to everybody, last week we talked to Kristen, and she was sort of giving a little background on how she would interact with us, right? What resource she provides for us. Very similar to your situation, but it's a new week, so maybe if you want to share your title, you can do that too. If you have a big fancy title you want everybody to know. But why don't you maybe share with the listeners sort of what resource you provide to us, right? Because we see you as a resource,
Yeah, of course.
right? So go
Of
ahead.
course. Yeah, absolutely. We are, we are in this together. We are business partners. You can view me as your expert on the life and long-term care, in the life and long-term care space. Consider me, your first call for everything, kind of a counsel, right? I am a consultative resource in regards to those two business lines. That is a passion point of mine. I'm almost like a technician, right? My job is to know this stuff so well, inside and out, and kind of regurgitate it and give it back to you from a sales perspective. And we've been working together now for a while, so.
Right. Well, Chris, why don't you sort of share, because I know right before the show, you were working on a case with Amy,
Yeah.
and sort of maybe set the stage, no names or anything, but maybe set a stage on, the interaction and how you would use Amy as a resource.
Well, Amy is a resource because I'm very, very knowledgeable in this subject, and she makes me look like I've never seen anything about it because her knowledge is just so much more vast.
Right.
So, in the particular case we were working on today, I've got a family of 4, and we've got different types of life insurance and disability insurance that are on this family to protect them. And it's actually all done pretty well. But I wanted to take it to Amy and say, have a look at this and see if it can be improved upon. And I mean, within minutes, because she knew exactly where to look and how to structure it. We're going to save this family a considerable amount of money every single month. And they're going to have more coverage in the first place. So once again, that comes back to that fiduciary duty. Always finding what is in the client's best interest. And Amy is a great resource for helping us find that.
Yeah, that's right. Yeah, exactly. Okay, so anything else you want to add to that?
No, perfect.
Okay,
Let's get on this crazy
All right,
train
yeah, that's right.
of long-term care.
Hey, that's it. Oh, nice play
how
there. I
about
like
it?
that.
Well done.
Nice. Well, that is well done. Okay, so this is where when we were sort of prepping, you guys were all about this segment, and I sort of pushed it off. But we're going to go to it now, so you guys will be happy, all right? And we were talking about sort of the different bias against long-term care. But first of all, before we get there, I think it's important to sort of make one particular comment that we were talking about over the break, Chris, and I want you to restate because it sort of will set the stage for really what we're trying to do, right? Which is
Talking about the families and how they
the
get
cost.
involved.
Yeah.
First of all, I've learned to use the phrase, instead of long-term care, I like to call it extended care, because it is a much, much bigger aspect than just the insurance that is associated with it. And the biggest problem that I have in the whole extended care part of your planning is not the costs. We focus on that as well, but it's the cost to the caregivers. So the average caregiver, Amy was telling me, was a 49-year-old female, and I believe it's usually the oldest daughter.
Correct. It
Is the one who is usually taking care of the elderly parent. That daughter, or whoever the individual might be, very frequently has to, cut off the number of hours that they work, or maybe even stop working altogether, which has a massive financial impact on their family, in order to take care of mom or dad or whoever the case might be. So I look at it on extended care planning as, how do we not just protect that individual and their assets and their nest egg, but how do we protect the other generations of people who will be drug into this situation, whether they want to or not?
Right. The emotional well-being, I think, is a huge deal. You have a lot of lifestyle disruptions that could go on.
Yeah.
Right? You said you have some people that may have to quit jobs or decrease hours. They may have families of their own. Frankly, in my personal situation, I was in Atlanta and my father was in Wisconsin. I was not close to him, right? So there was no opportunity for me to even do that. That wasn't a choice or an option, right? So you have even the physical hazards of people caring for someone who needs care, lifting, physical demands, emotional demands.
Yeah, that's interesting what you bring up, because we have a client right now that it's an elderly couple. Both are in need of care, and their kids trying to keep mom and dad at home, and they can semi-function at home, but not really. And they have our client, we have both mom and dad, and then one of the daughters. Well, one of the daughters is the only sibling in town. The rest of the siblings live everywhere, so she's taking the full brunt of all this.
And she feels like she has no choice.
And it is.
And she doesn't.
Right.
If they haven't properly planned, that is their option right now.
Right, and so she doesn't have a whole lot of, she has nobody to come in and basically sub for her.
Like on an informal basis, like an informal
Right.
caregiving option to come in and even relieve her for an afternoon.
That's
so she
it-
can go
that's it.
get groceries or
That's
go
exactly
back to
what-
her house and
Right.
you know.
She doesn't have one of her siblings to say, hey, you've got Tuesday night, I've got Monday night, you've
Right.
got Wednesday night. It's not that way. She's there every night, and it's a burden, and it actually has caused friction in the family, right?
Sure it has.
So and I know that Stan and I have had comments afterwards, we're like, oh my gosh, if they had just done the proper planning years ago, they may be able to offset some of this burden on their one daughter, and maybe the one daughter wouldn't have this, emotional situation going on with her other siblings when she can't help it, and none of the other siblings can help it either. So you just don't know the impact. It's not just financial. I guess that's the point, right? There's the emotional part of it that we hardly ever consider. This probably plays more into this than the financial piece. Although the financial piece is completely devastating, which we'll talk about.
Right. And it's interesting, real quick on that, Brian, is 70%, or Chris mentioned it earlier, let me back up. Chris mentioned it where, a lot of the claims don't just start in a nursing home, right? 70% start in home.
Right.
So that is a huge amount, a huge percentage where this is not go into the nursing home insurance. This is let's keep you out of the nursing home insurance.
But nobody wants to go to a nursing home.
That's right.
No,
no one wants to go, right?
Right. So they're always going to try to keep mom and dad at home. Although I will say this, we have a client that's in a nursing home here in town, and that's where I go visit him. And it's not your cinder block wall, smelly, weird smell nursing home.
That's good. That's good for him.
That's
to
great.
be in a great facility.
But
there's a price point that comes with that.
Absolutely, there's a huge price with that.
Yeah. Now, he planned properly, so he has a policy in place that's there and it's taking care of him. But again, he did the planning years ago, but the nursing homes today are not like they were 20, 30, 40 years ago. Totally different environment. You can go to every corner in basically the east side of Louisville, and there's a elder care facility, right? They're everywhere. So, they are stepping their game up in that capacity. So, all right, so we got a couple of minutes left, but what we wanted to jump into are some common myths or common biases Tad, why don't you take the first one on the list?
I think the first thing that comes to most people's mind is, I can't afford it, it's not in my budget. Things are already tight, where am I going to get the money to buy any kind of extended care or long-term care?
Yeah, we hear that one all the time. And I get it. I mean, when you start to look at some of the prices, especially, and again, I feel like a broken record. Not physically, but no, that was supposed to be funny. I said,
Sorry,
I feel like
that
a
was a fail.
Okay. No, but if you...
I did smirk. But.
You did.
You don't feel like a broken Rolling Stones record?
Yeah, there you go. It's a great play
there
from
we go.
last week.
Right, exactly.
Yeah.
Just tie it all in.
Yeah. But again, I say it goes back to proper planning can help alleviate a lot of what we're talking about, right? So when you say that, it's too much, well, if you wait till you're 70 and you try to get long-term care insurance, it may be out of your price point.
Exactly.
If you got it when you're 50, you were telling us that you see policies come through your door all the time that are a couple $1,000 a year.
Yeah. I mean, if you are buying in young and healthy, we're only the youngest and healthiest we are today, right? Tomorrow we'll be a day older, and
That's right.
And so the time is now.
Yeah, that's right. So anyway, proper planning is the key. That's the point we're trying to make. All right, we're going to keep talking with Amy. She is our long-term care specialist. We'll be back here in about 2 minutes, and we'll continue our conversation. You are rocking the bump music today, Jim. I'm
Wow.
digging this. I love it. All right, we're talking long-term care. I'm not sure that's the proper intro music for long-term care discussion.
Probably not.
But hey, I mean, that music was sold. Maybe those people do need long-term care.
Actually, that's a good
That's the
point.
generation, yes.
Okay, Jim, that's brilliant. I actually didn't think about that. Maybe I'm brilliant. I don't know. Anyway, okay, so at the end of the last segment, we were talking about different biases. And Chris, why don't you take the next one on the list?
Yeah, the concept that if you go out and you buy long-term care insurance, if you don't use it, you're going to lose all of the money that you put into it. And that's not necessarily true, especially with the new hybrid style long-term care products, which I know Amy will talk about. They can be structured where you're not going to lose the money if you don't use it. It is going to benefit somebody of your choosing if you don't use it.
Yeah, well, there's also the point that if you wanted direct long-term care insurance, right, and you're young enough, right, so we've done it, we're doing proper planning and we're young enough, and we evaluate whether long-term care insurance makes sense in our 50s, and it's price point to where we can afford it. It's kind of like insuring your home, right? You hope you never have to use it,
Absolutely.
but you have it in case you have a situation and you're protecting assets. It's like not, it's kind of crazy, but it's like not insuring your home.
Well,
You don't have to have, unless you have a mortgage, whatever. But if you run the risk of if your house burns to the ground, you're going to have to pay $250,000 or whatever to rebuild it, right?
Exactly. Even though the chances are your house is not going to burn to the ground, you still carry the insurance anyway because it would be so catastrophic if it happened to you.
Exactly.
That's why you have the insurance in the first place. You're hoping that you don't use it.
That's right.
For the people that in the tornadoes that occurred in Texas here recently, I have a good personal friend that lost their house in that. They are not upset. I mean, it's emotionally disturbing, but they're properly covered. That's what insurance is for. So the concept of I'm not going to need it, well, how do you know? And if you do, you want to talk about devastation if you don't have the planning to take care of that.
Right. To even take that a step farther is, the percentage of someone losing their house in a tornado or a fire is pretty slim, right?
Yeah.
Minuscule in comparison. If we, here's statistics for you, right,
Yeah.
Brian?
Oh, I
But,
love it.
yeah, here
Go
we
ahead.
go, guys.
Bring it.
In comparison, I have my trusty laptop in front of me. I don't want to miss some statistics.
That's right.
But really, I mean, the medical realities today, listen, approximately every 40 seconds, an American will have a heart attack.
Right.
We know, I mean, that's a serious, that is something very serious. Every 40 seconds, someone in the United States has a stroke. And the statistics could go on, right? And
Right.
we know that, 70%, a married couple, they are probably both going to need some type of care, whether it's in-home, facility, some type of
Right.
assistance as they age.
Yeah, well,
Right? So, the statistics, like from a house burning down to this, I mean, it's so drastic, but yet we don't do the proper planning to ensure these catastrophic events.
Would you say that that is because people don't understand just how catastrophic this event can be? People understand their house burns down. They get why that's a catastrophe. When you talk to advisors, is it because people just don't understand how big of a deal this is?
Yes, I think that's one of them. I mean, from an advisor perspective or a consumer perspective?
From a consumer perspective, I'm sorry.
Yeah, I mean, number one, it is our job to be counseling consumers and talking about this stuff, right? I mean, we can talk statistics till we're blue in the face, but really we need to talk about consequences.
Yeah.
What would this do to this nest egg that you have, right? We know that, I don't even have to look at my computer for this one, a 65-year-old couple in retirement, on average, healthy 60 to 65-year-olds will spend about $250,000 in health care. That's healthy.
Wow.
Over the course of their life.
Yeah, over the course of their, from
Yeah.
65 to 90 or whenever
Yeah,
they
yeah.
pass away. Right? Now that's $250,000 and they're healthy.
Right.
Now the woman is weighted a little bit more on that, like about $135 versus the $115. A lot of stats around that, but
Because they live
But
longer.
that's because women
right,
live
they
longer.
live longer,
Yeah.
right? And theoretically, someone could live with a cognitive impairment or some type of condition for many years. Now, the question would be how good is their quality of living, right? But so I think to answer your question, Chris, it starts with a discussion, right? And it starts with showing them the consequences and what this is going to do, and really how simple the conversation and really the solutions are. They are not difficult like clients perceive them to be.
Thank you.
No, yeah, I would agree. And I think what's interesting is we've had a number of clients that have come in, and we've sort of broached this subject of, hey, what happens if, right? Because and Ted, I know you've done this because we've had conversations around this over the last 3 or 4 years we've worked together, and that is when a client comes in and they've never done any planning, and we walk them through our software. Our software allows us to, in fact, sort of disable them to say, here's what happens if you become disabled or you need full-time care. And we just use national averages, right? Of, per day, per month. I get into the per day thing. No, it's sort of an annual thing. Hey, here's the average annual expense. And you can actually show a client if, here's the devastation to your asset pool if one of you becomes disabled, right? It's no different than, if you have a partner that passes away, you can show the exact same thing because we're talking life insurance as well. But it's important to say that when you're doing a proper plan, you can look at the scenario and say, okay, hey, I see what happens to my asset pool if my husband becomes disabled and he needs full-time care. But you can also say, okay, if you have the proper mechanism in place and it kicks in to provide an income or a source to pay the expenses, then look at the difference, right? And it goes beyond just having a mechanism in place to provide the funding. It's also making sure you protect assets, which I'm very passionate about, which is making sure your assets are titled properly. So in the event that you do need care, you can preserve assets. And that is not illegal. We hear that all the time. That's got to be illegal. No, it's not. It's in the code. And there are elder care attorneys all over town that do this very thing. And I just happen to have a client base that we do or have a lot of discussions around how to protect assets. So it's incredibly important that you put a plan together and you're looking at all the different scenarios. And I guess to say that, I say all that because if your advisor if your advisor has not had these conversations with you, and they've not brought up the subject of how are you going to fund care when as you age throughout life, make sure you give us a call, 502-233-9800. Come visit us. You can have a conversation with any of us. We're not going to charge you for it. Come in to visit us and say, hey, what does all this long-term care mean? What does it all mean? And in fact, if you actually want to have a conversation with Amy, well, she charges, but maybe we'll. She does
I charged chicken and waffles last night. They were amazing. So if you that's my cost.
Yeah. So, but no. If you have an interest in having a conversation with somebody that all they do is talk long-term care insurance, or if you have, a life insurance policy that you want us to review. Again, that's not what the subject of today is, but that's a resource that we have in Amy, right?
Absolutely.
And we've done that. So we've said, I think, Krista, you've done that.
Yeah.
Today.
Today.
Yeah,
At
today.
11 o'clock.
Yeah, so we take a life insurance policy, an existing policy that's been in place for a number of years. We send it to Amy and say, hey, have your crew evaluate it and give us your feedback on it, whether it's a good policy, whether it's not a good policy, where it's headed, or whatever the statistics are, and then what is maybe a viable option to either replace it or add something to it to make it a better policy, or whatever the scenario is. That's the resource that Amy provides us, right? So I think it's a great
Correct,
resource. All right, so with a couple minutes left in this segment, let's jump into, we got about 2 minutes. Let's jump into some of the solutions that are out there. Now, I'll start off with one, and we're going to get into more of the others, but right before the break. So we have lots of conversation with clients around long-term care insurance. And to go back to the sort of biases, if we have run lots of scenarios where we, call Amy up and go, hey, this person wants, a long-term care quote. Very few providers even offer that straight long-term care insurance anymore, correct?
That is correct. I mean, the long-term care insurance landscape has changed drastically over the past, 20 years or 30 years. How many decades ever you want to call it. And, where we used to have a couple dozen carriers that, issued standalone long-term care, that's not the case anymore. It's a different playing field right now. There's probably a handful of carriers that offer your traditional standalone long-term care,
right.
Good reputable carriers, and absolutely reasons why that may be a fit for certain individuals. There's no
right.
question. Then we have kind of this new landscape, if you will, and it's called the hybrid combination space.
Right.
And it may seem like a big space, but really in its essence, it is the insurance carriers got smart, let's say. They got kind of creative and smart when they've created these products, because we all know with long-term care, objection is if I don't use it, I lose it, right? So what did they do? They decided to create products that have a life insurance or a death benefit attached with kind of a big long-term care kicker, if you will. So again, a hybrid combination product, and we do that with a couple different chassis with big long-term care kickers, if you will.
Yeah, we'll discuss those over the break, but yeah.
All right.
Yep. No, keep going.
I'll
just
gotcha.
do that.
Yeah.
Well, no, don't keep going, because this is a break. So maybe we'll do this on the other side.
Awesome.
All right, this is Peace of Mind Radio, and we are talking long-term care insurance, and hopefully if you're driving to the Mexican restaurant on a Sunday afternoon, you're not falling asleep when we're talking insurance, but I promise it's important, so stay awake. We'll be right back here in about 2 minutes. All right, this is Tommy Lee. I'm sorry.
Is this Dr. Feelgood? Oh. Maybe not.
No, this is
like-
Wild Side.
Oh, I was like,
that's right.
because
Wow.
Dr. Feelgood would be a really, Dr. Feelgood would be a
Can
cool.
we start over? No, I'm kidding. All right, so we are talking long-term care insurance, and before the break, we kind of mentioned some of the biases, but we actually we left one out. We sort of breezed over it, but want to make sure to go back and address it. So Tad, why don't you address that one? Because I think that's an important one that we hear a lot.
I've heard this said a number of different ways, and people find lots of ways to explain why they think they're not going to need any type of long-term care. My family died young, my family is healthy, and they live to an old age. My favorite is I'm going to work until I die. But there's a misconception with a lot of people that I'm never going to need this, thinking that long-term care means you're going to be laying in a nursing home bed for a year or two.
Right.
And that's not the reality.
Yeah, no, that's a great point, Tad, because 70% of the claims start in home, right? And with the statistics that we just talked about, a couple more from my trusty laptop.
There's that laptop again.
Coming in handy, guys.
I'm bringing a laptop in.
You
next time.
should.
Oh, we're going to be
Yeah.
Googling like crazy out here.
I'm not Googling. I just have some good things in front of me that I want to share.
I'm a Google.
I'm
just going to Google.
Well, I do like to Google, but I don't have to Google this stuff. There
Got
was
it.
just a few things that we want to make sure our consumers know,
Yep.
right? And
Got
we
it.
don't want to forget. So, but 92 million American adults are living with some form of cardiovascular disease. That's a lot. I mean, there's how many
Wow.
people in America? 300?
320, 330. Yeah.
Million?
Yeah.
That's like a third, or
Yeah.
not, maybe
Yeah.
25%.
Right.
And so again, statistics, blah, blah, blah.
I mean, let's be honest.
but they're realities, right? These are medical realities. So for someone to say, I'm not going to need it, you may need it, but it may be in your home, right? So how do you create plans that have the flexibility, right, for clients to stay where they want to stay? The freedoms of how they want their money to come, right? How they're going to pay for this stuff. Informal caregiving to give, their daughter, the 49-year-old daughter, a break.
Yeah.
Right? And so there's too much medical reality for that to be we have to overcome that, right? We as advisors have to consult and talk to our consumers about that, because they're off their rocker if they think that nothing is going to ever happen to them.
I had a conversation yesterday with a friend of mine. He's in his mid-50s. In the last 2 years, his wife's parents have both passed away. He had Alzheimer's, she had a stroke, and was disabled for 10 months. Now, they just put both of his parents in assisted living facility. They're in their mid-80s, and they're spending lots of their time taking care of their parents. And we're talking about a stretch of probably 4 or 5 years, maybe 6 years, where between the two couples, they're going to be providing some type of care.
Right. Well, and your clients that are in their 50s, I mean, that is a beautiful time to buy. You buy in low. There are so many amazing options right now, from 10 pays to 7 pays, 5 pays. I mean, you could buy in at 55 and be done paying for something by 65.
Explain what you mean by 10 pay and 7 pay.
Oh, sure. So, like I said, the carriers have gotten really creative in terms of their product design and really kind of taken a lot of the consumer objections into account, which is amazing, because as financial planners and doing the right things, that's amazing, right? We have choices. And so, for instance, we can do, instead of someone paying on a policy forever, for example, they could do 10 years of payments, and it can be paid up, guaranteed benefits, freedom, flexibility, and done and done. They are done paying for it, and this is something that will stay in force for the rest of their life. And if they don't use it, no harm, no foul, because we have a death benefit attached, and the beneficiary is going to get a tax-free benefit. Again, these are all tax-free benefits, folks.
Right.
I mean, that is an amazing, amazing blessing we have from the IRS. That is a blessing.
Yeah. So Chris, why don't you sort of explain, we're kind of throwing this hybrid analogy around,
Right.
but maybe I want you to explain, because I've got a pretty cool case that I want to talk about as an example, but maybe explain what we're talking about, generically speaking, when we're talking about hybrids. What does that really mean?
Okay, so the traditional long-term care insurance policy was like any other type of insurance. It was, you bought that one thing and whatever the parameters were that you wanted to get. Probably the biggest complaint that I heard from people about those is that, yeah, but the premiums keep going up, which they do on a traditional qualified long-term care policy. The premiums are most likely going to go up multiple times over your lifetime. So what they've done, what Amy was talking about, the insurance companies have answered the consumers and said, okay, what we're going to do is we're going to attach the long-term care to either a life insurance policy, or it can be attached to an annuity, for example. And in doing so, they can guarantee that those premiums will never go up. Or as Amy was just talking about, 5, a 7, a 10 pay, where you pay on it for a predetermined amount of time. It is now paid in full for life. You never have to worry about that again. And the hybrid product allows for that. And it also allows for, if you don't use it, or if you don't use all of it, when you do pass away, it passes on a certain amount of wealth, tax-free, to kids, grandkids, whatever it is that you want to do. And that's really what makes the hybrid exciting compared to what we had.
Oh, completely, because now, clients can say, yeah, hey, I'm paying in, but, and I'm going to use an example in just a second, but I'm paying in. If I become disabled, there's a benefit. If I want to have access to the funds, I can access them. And if I pass away prematurely, there's a benefit to go to my heirs.
Right.
Right. It's a great concept.
It is. I mean, it's the live, die, get sick concept, right?
Right.
One of the three are going to happen to you. So there are
Right.
products in the hybrid space that, if you need it for one, great. It would affect the other two, but you can just pencil in and be so flexible with your client base.
Yeah, so and I'm going to give you an example. So this is a case you and I are working on.
Yes.
It's actually in underwriting right now.
It is.
So what the scenario that I took to Amy was, I said, okay, I've got a client who is interested in leaving a death benefit if they should die prematurely to a couple of her people that work for her. And she's also constantly on me that, hey, I have a couple extra dollars, I want to be able to do something with it. She has plenty in the market. So we're always looking for a little bit different avenue for something for her to do. So what we designed, or what I shouldn't say we, I was part of the discussion, but Amy really designed this, was I just took her the scenario, and Amy said, hey, why don't we take a look at a permanent policy where we're going to really try to not necessarily minimize, but somewhat minimize the death benefit, because she didn't need a huge death benefit, right? But what we're trying to do is sock away a lot of cash into this thing to have the cash value of the policy grow. And the reason we're doing that is, one, we need a death benefit, right? So it could go to her two employees. We were trying to create enough cash value that it accumulate over time, so that if she needed it, if she didn't die and she's like, hey, I just want the money, we could then produce some sort of retirement income in retirement to use in that cash value tax-free.
Right.
Right.
It kind of closing the gap in retirement, like
Right.
another additional income source.
Yep. And then we put an option on it, I should say, that allowed her that in the event that she becomes disabled, she can access the funds and I won't get into the particulars of it, but she could access the funds, which actually gave her $11,000 a month.
Yeah.
Which is more than any facility around here would. I mean, you'd get a great facility, right? But again, she's accomplishing 3 different scenarios with one product. It's a great solution, and that's the point. That's the resource that Amy has for us, right? Is we bring her a situation and say, hey, we got this situation with a client, and she essentially says, hey, here's the solution. I didn't know that solution was available. Amy said, hey, let's walk down the road. So we did. It's a great solution. The client loved it. It met many needs for her, and she's in the middle of underwriting.
I think you kind of hit on something with Amy and with Kristen last week. The real resource that they provide is, you want to be working with an advisor who's extremely knowledgeable of all the different things that you can go into to solve the problems that the client brings. And these people, these young ladies, just bring a wealth of information to us and make us better at taking care of those clients because of the knowledge and the research that they have.
That's correct, and that's a great segue to say, if your advisor has not had this conversation with you, make sure you call us, because we will.
Absolutely.
This is Peace of Mind Radio. Our phone number, we've got to get that out, 502-233-9800. Give us a call, visit our website, peaceofmindradio.com. That's it for another week. And Ted, you want to say bye?
Thanks for tuning in.
Have a good
See you
week.
next week.
Yeah. Thank you, Louisville.
Hi, thank you so much for watching our content. We really appreciate it. If you like the information, make sure you hit the thumbs up button below this video. Please share it. We would greatly appreciate that as well. And if you want to make sure you receive our future content, make sure you hit the subscribe button and you'll be notified when we put new material out. Thanks for watching, and have a good day.